Welcome out, everybody, to the Market Watch Group. Options Foundations. There was just a little bit. Link was posted on Discord and on the schedule. Okay, good. I thought I had I put it in enough places. I was going to send an email a little earlier than I did, just making sure. But it sounds like everybody had an opportunity to grab that, and we are all here. Let's get into it. If I didn't say hello and you did, welcome. Intro to options. So there's a couple of different ways, right? I want this to be, and we're going to go pretty quickly. You're going to see when we look at the agenda for this. We already have, and that's why I'm going to go pretty quickly on intro to options today, because we already have intro to options, 2 of them, from our Trading Foundations class. Don't forget, and I'm going to show that to you again. I'll bring it up. I'll show you where the link is. So we're not going to spend a ton of time. One time. Thank you, Bob. He said happy birthday. I appreciate it. Very nice of you. So let's dive in. I am Scott. We are running forward. These are the disclaimers. As always, the same as always, they are in your emails. This is our agenda tonight. Options Foundations course agenda. So I'm going to walk you through the next 8 sessions. The next 4 weeks. December is options month, right? December is options month. We're going to look at tonight's agenda, specifically the topics we're going to cover. We're going to talk about understanding financial derivatives, why trade options. You want to have a good sense of what you're doing, right? Why are we trading options? We want to have the basics of options. Again, I'm not going to dwell, but if we have 2 or 3 different ways for you to go about just covering the basics, making sure you're comfortable with the terminology, the definitions, with rights, with obligations, with strike prices, with everything along those lines, the better. So we want to make sure that we talk about options basics here, touching on them, but again, remember that there is approximately 90 minutes of basic options content that already exists for a couple of our sessions from the Trading Foundations. I'll show you those links. Next, we are getting into options. I'm going to say this is a need. You need access to an options pricing model. Most brokers these days will have something at least. When you watch me on the platform that I use, the platform hasn't changed. I'm still on Thinkorswim. When I first was on it, Thinkorswim was its own company. Then it became Thinkorswim by Ameritrade. Now it's Thinkorswim by Charles Schwab. It's the platform. That's what matters. That platform has the charts. It has the options pricing model. It has the order types, conditionals, first trigger, OCO, things along those lines that are very, very useful for options trading. But if you don't have access to a pricing model, you want to find it. Try to figure it out. Great conversation if you don't for Discord. As a plug, pop on there. Tell us who you're trading with. Tell us who you looked into. You'll hear people respond back, who they have used and things. So remember, we really want to continue to develop that aspect of our group. And then we'll give it a quick summary. So first and foremost, here's what you're in for. Intro to options tonight. Great. We're going to fly through it. It's one night because we have other content there to help you go and as a refresher, if you don't feel like your foundation, if you don't feel like your basics are strong, this whole thing is the foundations. If you don't feel like your basics are strong, go back to those first 2 intro to options. We're jumping straight on Thursday into key concepts, terminology, and basic options strategy. That means buying, calls, and puts. Speculative, just right swing trade, buy a call, buy a put. No, there's no there is leverage. There's no margin required. You're just paying cash. But we're going to immediately, and I want you to think about this. We talked about this before. It's building blocks. Everything we do builds. So we start as buyers. With buyers, we have rights. Then what? Then we talk about sellers. As sellers, we take on obligations. Then we look at, now that we understand these two blocks, what if we stack them together? And now we're talking about spreads. We'll start with credit spreads. Then we'll move on to debit spreads. And as you start to think about spreads, you start understanding why. What are spreads doing for me within the context of my trading strategies and trying to implement strategies that align with my market posture? Well, we start to realize it's about time and volatility. And we start to think, oh, time spreads. That sounds nice. We'll finish with advanced combination strategies, fancy. Condors and iron condors and butterflies, this such. And then we're going to round it off after we've talked about everything with a better understanding of implied volatility and the Greeks, because once you've gone through each of these strategies, I promise you this, your understanding of what the Greeks mean. Because as you learn these strategies, it's not like I throw a dart and say, oh, today it's debit spreads. Of course not. Everything we do is extremely deliberate. So what you're going to understand is the Greek profile of a debit spread or a time spread. I'm delta neutral. I'm theta positive. I'm vega negative. What does that mean? Why would I want that? What would that do for me? When we start to understand options from that level, it opens just a world of better management and better planning and execution. Very exciting stuff in front of us. Let's get today under our belt, tonight's agenda. First and foremost, existing resources. Let me just pause right here. Right? Let me just pause. Whoops. Okay, I'll come back to that. Let me pause right here. Now, remember, this is what Steven said. At any given time, all of these are available to you. For tonight, you have the source of truth, the Market Watch group, meeting schedule and links. This is your source of truth for the schedule. At any given time, this is accurate. So you can see right now the Trading Foundations course is in red on hold until the first Tuesday of January. Instead, you have the Options Foundations course, and here is the link. Same thing for Thursday. So if you need to, go to an email, grab this. This is going to tell you that Trading Foundations is on hold. We'll start the next cycle in January. Right now, it is Options December, a holiday and options extravaganza. It's going to be a lot of fun. You don't want to miss a single day, so make sure you come here to find those links. The existing resources then are in your content library. If you scroll down into the Trading Foundations, chock full. Everything is in here. That's not true. I have a concern. If you remember, we had a weird issue with the recording the very first one. And I think I have to go look and see. I thought I had uploaded that. I'll have to go back and see. But everything else is in here, including Intro to Options Part 1, Intro to Options Part 2. Go take a look. You have plenty of existing resources to help you out. That you're very welcome. Bobby said it's our Christmas present from you. I am excited to talk about options all December long. And as I told you earlier, I will be introducing you to a new team member of our coaching and analytical staff. Gary Pacanini is going to be joining us. You might see him on Discord already. He's going to start joining and running some sessions on Discord. He's going to deliver one of the sessions coming up and actually take probably one of the nights as his. And it'll be great. He's a phenomenal trader, fantastic person. Very excited to have him part of the team. We're very lucky to have him. All right, let's get into the rest of this. Let me get my slides turned back on. Oh, that's the wrong way. Let me switch there we go. Okay, a couple of things I want you to walk away from here with. This is our objectives. I should have said tonight's objective. Understanding financial derivatives. Hopefully you have a sense of this already. I would imagine some of you have already traded them. But what do we mean when we say financial derivatives, right? The option, what are you trading when you trade an option? You're trading a contract, and you're like, that's a very ambiguous term. What do you mean a contract? And you need to understand that contract is a derivative, or it is derived from the context of the underlying stock in this case, or as it may be, the underlying index or the underlying futures contract. There are options based on futures options, but these are contracts that essentially establish some level of control, the right to buy, the right to sell. So it is derived from the financial instrument. Most of what we're looking at together are going to be equity options or stock options, right? That's what falls into this category of an underlying asset. But keep in mind, as you explore options, and there are tax advantages that exist for things like trading options on indexes. Well, we trade a lot of SPY. We look at SPY or the S&P 500. So could you do the same thing and use S&P 500 options? Sure. Why would we be reluctant? They're enormous. They're riskier. They're 10 times bigger than SPY. So I'm going to say move slowly as you move into options. The other thing I want you to understand better as an objective is, why are you doing this? What it's not just, a lot of people are like, oh, I get more for less. That's very oversimplified. We definitely want to keep things simple. We do not want to oversimplify. So we want to look at the advantages like flexibility, like the ability to control risk. It amazes me when people say, oh, options are so risky. Are you sure? Because I believe we can control our risk better with options than a lot of other things. We can look at the disadvantages, such as time decay and to some extent the complexity of options trading. We'll also look at the comparison to just buying stock, right? And then we're going to give it a quick basics recap. Next session, we jump straight into terminology and basic option strategies. Tonight, we're going to look at the pricing model, but we're not going to do any specific tasks. I'm just going to kind of show you some of the features. Every other time, every strategy we are going to be building it in the pricing model. So I'll show you how you have the ability to construct and alter the potential trade way before you even consider taking it. You can do it in a safe environment and start to understand, what would your risk be? What would your reward be? How does time hurt or help you? What if you could look at the potential of your position sizing? So it'll be a very interesting exercise even today. Okay, so first and foremost, let's better understand financial derivatives. Definition and purpose. Derivatives, in this case, financial contracts rooted in underlying assets, are going to play a crucial role in our risk management and in speculation. We do both in our group. We talk a lot about hedging, and when we hedge, obviously we use options. A derivative of the S&P 500, giving us control to the downside. But a lot of what we look at are essentially the potential to trade options. One of the things that we've been exploring and identifying particularly recently is low implied volatility, right? Which means what? Options are cheap. Perfect. What else? They serve as a dynamic tool that derive value from the performance of the underlying asset. But they also are influenced by their own financial dynamics. So you've got two things going on at once. The stock is going up or down. The stock going up or down is going to influence intrinsic value. We're going to talk about intrinsic value in greater detail and define it later tonight. The options market with buyers and sellers coming in and out, and the options market makers watching the order flow and watching buyers and sellers as they have more buyers or more sellers are going to be inflating and deflating options and manipulating the price based on the supply and demand of the options. That is impacting the extrinsic value or time value. Those are the two basic components. Again, we're going to talk about that a little bit more. So there's a second dimension to what we're doing here. What is the trade-off then for us accepting a more complex market? Significantly more flexibility, the ability to do so much more in how we trade. So that's the world that I get to expose you to. As a basic overview of options, they are a distinctive derivative type involving contracts that give the holder the right, sans obligation, to buy or sell an asset, to buy or sell the stock. Remember that the buyer, the holder, has rights. There is an obligation involved in this contract. So if it's not the buyer who has it, we know, of course, then it's the seller. Buyers have rights, sellers have obligations. We go through that over and over again because that's the part. You just kind of have to wrap your mind around it, just sort of commit it to memory. If I'm a buyer, what do I have? Buyer of a call, right to buy. The right to buy the stock, because what do I think it's going to do? Go up. If I buy a put, I have the right to sell. The right to sell the stock because why? Because I think it's going to go down. Those rights will increase and decrease in value as the projections are either come to fruition or actually go against us, right? The flexibility gives traders the ability to navigate market conditions with a more concrete definition of price and time, right? We look at predetermined prices as determined by strike prices of the underlying strike, and time frames as determined by expirations. So those are a couple of the definitions that if you don't know them now, you will know them soon, right? The strike prices, those are the agreed upon prices distinct to each individual contract. The type of option is call or put. The expiration is when does that option expire? Okay, as a point, and I don't actually think I have it in here. I think it's something that we would hit next week again. When do they expire? Saturdays at midnight. Standard options expire the third Saturday at midnight. When do they stop trading? Friday at 4 p.m. Can weird things happen in between Friday at 4 p.m. and Saturday at midnight? Yes. Can, has, will. That's why it's important for us to know things like our rights, things like auto assignment, auto exercise, where if my contract is in the money, the broker's going to exercise it for me, and I'm going to end up with a stock come Monday morning. Things like our obligations as sellers and assignment and what that means. So yeah, we're entering into contracts. We want to make sure we understand who has what rights, who has what obligations, because when we do, we are empowering ourselves with just a much stronger arsenal of tools to match the conditions of the market. Understanding options give us a better understanding of the role they can play in shaping strategic positions. I can trade for sideways markets. I can trade for slowly trending up markets. I can trade for fast falling markets. Right? You find a market condition, we can find an option that will make sense in that market. We can find the best way to trade. And it gives us unique avenues for financial maneuvering. Very good stuff. I'm excited. I hope you are. Some of the advantages, flexibility, right? We are very specific in our market posture. And we look at it and we say, I am neutral. I am more bullish. And As we do that, we want to potentially construct trades that mirror that and say, how can I trade for the fact if the VIX is a negative score, that means the VIX is high. What do you want to do? You want to be very careful. Options are expensive. You probably want to do some selling of options, right? And so the market posture, when you understand volatility, is going to help us to understand what strategies make sense. We talk about time frames. How much of a time frame should we take, right? And what strategy makes sense, the most amount of sense given market conditions. We have the potential for higher returns. That's for sure. Right now, especially with cheap options, we have the ability to manage our risk better. And you'll see when we look at the pricing model how you're going to very specifically quantify and control your risk no matter what trade you take. And again, it's versatility, bullish, bearish, neutral. Okay, a lot of good stuff. A lot of good stuff. So what's the pawn? If I'm getting something, I'm sacrificing something. If you don't know what it is, you're putting yourself at risk to get hurt by it. What are the challenges? Time. Time is tough. It's hard to get right sometimes, to be buyers and sellers at the right time. Time decay is probably the number one thing that hurts amateur traders in options. So we want to make sure we really get a sense of how that works to make sure that we either mitigate it or put it in our favor. The other disadvantage of options that I really want you thinking about is there is an increased complexity. I absolutely highly recommend paper trading in the beginning of options. Just like if somebody were going to learn how to fly a plane, which can be dangerous, they're going to have you do some time on a simulator and learn in a risk-free environment. And I'll tell you what, if it was me in that risk-free environment, I wouldn't just want to learn how to fly the plane. I would also, and maybe this is just me, but I'd be like, you know what, can I just try some things? What would I try? I don't know. What if I did this? Pull back real hard, pull left, pull right. I want to see what can I not recover from? I'm just going to trade. Well, or in that case, I'm just going to try some things so I can see, wow, yeah, never want to do that, right? Same with options in the beginning. The great thing about a paper account is you can always reset it. So you can come in and just buy some calls, buy some puts, buy it out of the money, buy it in the money, just really get some free experience because there is an increased complexity. It demands a more nuanced understanding. There is potential for not just for significant losses, but quickly, right? People will, I'm just going to buy for 2 weeks. And all of a sudden that's gone. You blink and it's gone. And you lose everything 100%. That's dangerous, right? So we really have to emphasize the importance of risk management here. Okay, how are we doing on time? Pretty good. I want to make sure I give you at least 10, hopefully maybe even at least 10 minutes. I'm not going to give you 15. 10 minutes for questions. Basics of basics of options. Bob said, more important to learn how to land the plane, meaning cut losses. Amen. What a great call out. Love it. The basics of options, again, quickly here, because there's more resources for you. I don't need to spend time tonight on it. Just want to touch on it. We're talking calls and puts. Call options we use to profit from anticipated upward price movements. Remember, we always start our building blocks as buyers. That's our premise. The same thing when you go to the foundations, we're going to start those building blocks as buyers. That's why we're going to feel comfortable only spending one more session and then moving into the concept of sellers. That starts to round out the education. So put options are used for a couple of reasons. Number one, to provide a safeguard against falling prices as a hedge, or to empower you to profit from market downturns, profit or protect. Remember option pricing, intrinsic versus extrinsic value. Intrinsic value signifies the real-time value, the empirical value. In one situation, it would be the stock price minus the strike price. If the stock is at 70 and I have the right to buy it at 65, I have $5 of intrinsic value, or vice versa for puts. That is the intrinsic value. If it has intrinsic value, they don't all have it. If it has it, that means it's in the money, intrinsic value. If the other component is extrinsic value. Extrinsic value is time value. When you hear about options inflating and deflating, market makers don't have the ability to inflate intrinsic value. That's empirical. It's based on the relationship between the stock price and the strike price. What options market makers will manipulate, and I don't mean manipulate meaning, oh, they're tricking you. That's the part that they will inflate or deflate based on order flow. If a lot of people are buying options, what are they going to do? They're going to raise the price. Well, they can't raise the price of intrinsic value. Only the stock price going up can do that. They raise the extrinsic, and that inflates. We need to understand that process so we understand if we're on the right or wrong side of what it is that the market makers are doing. Again, making sure we understand the increased complexity that we're up against. Factors influencing prices, meet the Greeks. Remember, we're going to spend a lot of time on these, but we're going to push them to the end. If you want to look into them, you can. Delta, gamma, theta, vega. They are going to be something that you learn about and start to analyze when you are using an options pricing model. They help to determine option premiums. They guide us in better managing risk and making more strategic decisions. Okay, get access to a pricing model. But what does that mean? You might be like, what do you mean a pricing model, Scott? So let me show you mine. Now, and this is a great reason why. So I was looking at a comparison of two strategies. I was working with somebody and they said, I heard about a strategy where you sell 100 shares of a stock short. In this case, it was the SPY. And you buy 2 calls. And they said, what are they trying to do there? I said, I have no idea. It's not a strategy I'm familiar with. So this is where having an options pricing model. So here I am. You can see I'm in Analyze. And I have a couple of things. I can come into Add Simulated Trade. So this isn't to paper trade. That's different. Paper trading is done. I'm actually in a paper trading environment. If I did a trade, that's a paper trade. Simulating the trade is just to simulate it in the pricing model environment. I have the ability to plug the trade in and say, what would this thing look like? So the way you can look at it as a what if environment. So what did I do? I said, what if I do that trade? Now, I can do all the what if with buying the stock and looking at the various options available on the stock here in the simulated trade environment. What has it given me the ability to understand this risk profile? So I can come in and say, if I short the stock and buy calls, this is what I have. I said, oh, now what do I have here? Let me get drawing tools. I need drawing tools. What do I have here? This whole big chart. This is a risk profile graph. Every option strategy has a risk profile graph. In fact, I think you could Google SIBO risk profile poster. And they have like this, shows you all the different, like, this is a call, this is a put. So I could show you a call. This is the risk profile of a call. What does this mean? This is a zero line. So you can see this is profitable. There's pluses here. And this is negative. There's minuses over here. So I can only lose so much fixed loss. How much can I make? It can go up forever. It just keeps going up and keeps going up and keeps going up. That's why they say there's unlimited upside potential. Now, that means the S&P would have to go up to 700. We don't really think that's a viable thing. Our life exists closer around here because we're only looking for certain amounts. But this says that I make money if the stock goes where? From 440 to 450 to 460 to 470 to 480. If it goes up. If it goes down, I lose money, but I can only lose so much. All of that information is found in this risk profile. That's what's great about it. If you learn to read a risk profile, you will learn how to understand options significantly quicker and better and easier. What do I see here? I see risk. I see reward. I see how time. I look at this and I can immediately tell you how time is going to impact this trade. So now I can look at this and I can say, what does this look like if I have both of these on? It looks like if it goes up, I make money. Or if it goes down, I make money. And you might be thinking, what? If it goes up or down, I make money either way? Yes, that's true. Except remember what else is happening? Time. I'm actually at December 5th. Time is ticking. So if it doesn't move, what happens? Well, it starts to drop from time. Now, what I told the person that I was speaking with was, this looks an awful lot like a straddle. What is a straddle? That's where I buy a call and I buy a put. So if I uncheck these and I check this, this is a straddle that looks exactly the same. Now, when do straddles, are straddles a viable strategy now? Yes, they are. How would I know that? You won't yet, but at the end of this month, you will. How would I know? Because implied volatility right now is low. It's cheap. If implied volatility is low, I think it's more likely to go up than down. And that means I'm looking for Vega positive strategies. They're going to be more helpful to me. This is how I'm going to show you how with options, we can match the strategy to market conditions, so that when we say implied volatility is low, we want to understand, well, what kind of Vega should I be looking for in that market? What is that going to do by way of theta? And what am I thinking happens with delta, meaning price going up or down? That's a lot. Why did I want to show you this example? Not because I expect you to understand the difference between these two strategies. That's not at all what I want. What I want you to understand is, in every option strategy, there are a lot of moving parts. We cannot organize that in our heads. We need help. We need the right tools. If you're going to trade options, you absolutely must have the right tools, and you must learn how to use them appropriately. And that's a big part of what we're going to be doing, not just in this 4 weeks of options foundations, but as we trade. I know most of you are oriented in options, and so we want to make sure that that's a part of what we're doing. So do I expect you to be able to know how to use these price slices and understand how to manipulate trades down here and then know what it all means up here? Nope. What I want you to do is get access to it. Bring it with you, whether it's Thinkorswim because you go do that, whether it's through a TradeStation, whether it's through Tastyworks, whether it's through, I know there's a number. You can find at least 4 or 5 that are going to have these. Doesn't have to be this one, but it has to be something where you can have the ability to do what we're doing here. The vast majority of our work will be in these 2, but we're going to be using this every time, starting next time. What are we going to be doing? Buying options. Then remember, then we're moving to spreads, and then we're moving to the more advanced. And so as we build and understand how they work, you're going to be learning how to read a risk profile simultaneously. Okay, let's go back. I'm going to give you some time for questions. A quick recap. We will definitely be looking at a single options chain, without a doubt. We'll want to make sure that you understand some of the fundamental concepts of financial derivatives. So what we did today, plus what you have available to you in the trading foundations, the reasoning behind options trading. If you don't have a sense for that, make sure you do. You have motivations for why you're here. Obviously, starting to talk about the basics of calls and puts and understanding option pricing factors. It's option pricing factors that we're going to be manipulating when we go into an options pricing model. What are we doing next time? We're going to dive deeper into key concepts and terminology, and we're going to explore basic option strategies in more detail, including building both a call and a put. Remember that we did in our trading foundations, we did a case study, a couple of case studies. Go back to the content library and review those case studies, because we're going to use those case studies and go back in time and simulate buying a call. We'll simulate buying a put using those case studies. So those are trades that we either found or would have found in our group. And we're going to use those case studies to build these other types of trades. So go refresh yourself. It'll be very helpful. Okay, questions. I didn't give you 10. I gave you 6 minutes, but if I have to go over a few minutes, of course I will. What do you got? Have you tried options? Were they difficult? I know. So for example, I know Steven's always very willing to share. Steven told me, he said, hey, I've done buying calls and puts. I didn't love it. He got burned by exactly what we talked about, right? He switched into covered calls, selling puts. That's an option income cycle. Beautiful cycle, right? That's a beautiful cycle. Happy Steven said, how was your birthday? Did you get what you want? Here's what's crazy. My son, who left Billings around 10:30, is literally gonna pull up here in the next 5 to 10 minutes as we shut down. So I'm gonna get my present here in about 10 minutes. We're all gonna go to dinner. It's gonna be amazing. So no, I'm good. Bob says, give you a few minutes. No, I'm gonna answer your question. So covered calls. That's a great option strategy. Very strong in a neutral, in a slightly bullish, even in a bullish market. It works in multiple markets. Is it highly speculative? No. Is it going to generate huge reward to risk? No. Is it going to get singles and doubles, constantly getting on base, constantly scoring? That's a beautiful strategy. Is Steven, and he's mentioned this as well, thinking, hey, I might start doing a few speculatives here and there, using the strategies that we implement for some swing trading. Yes. Right? Yes. Any other questions? Let me know. Let's get those. Let's get. So, what else? Any other questions? He says, I have 8 covered calls. 4 will exercise as of today. Exercising meaning it's achieved max gain. 2 straight calls, PLTR and APPS. Oh, PLTR coming back. 2 covered calls, won them both. Bob said, very nice. Love it. These are the things. Here's what I'm going to tell you. We might even have to open a sub channel on Discord specific for options discussions. And if we start to see that happen, great. We're flexible. We'll do it. Whatever we need to do to make that channel as effective as possible to allow you guys to have better discussions. If we want to have 2, we'll figure that out. What else? Any other questions before we wrap this up? Don't forget where to find the link for Thursday. Don't forget that we are we have the additional resources for you, both the 2 options foundation, or the intro to options, 2 recordings from the Trading Foundations course, and the case studies, a bullish case study and a bearish case study. I have a very cool feature in the platform that I use called Think Back, where I can go back and simulate what it would have looked like for us on the exact dates of those case studies. so that we can look at, what if I would have bought a call here? What would it have looked like on this day? Very cool stuff. You're going to have a lot of fun. Steven says he's completed his first 100 trades, started the next 100. Love it. I would love to see your first 100 assessment. What did you learn from those first 100? This is what we want to do when we move from the first 100 to the next 100. What did you learn? What can you do better? What are you going to focus on the next 100? What are the mistakes you made in the first 100 that you're going to make sure you don't make in the next 100? This is where to find that Kaizen, right? Where do we find those marginal improvements, or even more than marginal improvements? I love that. Steven said, please let everyone know to use the spreadsheet. Yes. Bob said futures are up tomorrow, hoping for a bullish day. I agree. We are bullish in our posture. We've been patient. We've seen some things, some consolidations, waiting for triggers to show up. I think we're there. Anything else? Any other questions? Amazing first day. I hope this whets your appetite. I know for some of you, you're like, yep, I know all this. Let's get going. But for some of you, this is going to really confirm some understanding, some concepts of why you're here. What are options bringing to the table? Why is it worth it for you to learn them? And for me, it's particularly because of our process. The market dictates everything. Let's match it as well as possible. And it makes it easy for us to start to transition to be more bullish, etc. Bob says, Yahoo says most people would not buy a Cybertruck. I'll tell you what, I'm asking for my refund. I want my 100 back. It's not what I was promised. They wouldn't even throw did you see the little softball baseball toss? They threw the baseball at the window. They're like, oh, it didn't break. Come on, man. You promised me bulletproof. Anything less is unacceptable. Sandy says, looking forward to these sessions. I'm looking forward to being here with you. Press says, great foundations. Thank you. Thank you, Press. Good to see you, sir. Thank you for the happy birthday wishes, everybody. I'm going to go. My son came in. My dog was sleeping in the office. He popped in and the dog just like lit out. So I'm going to go participate in the celebrations. Have a birthday dinner. It's good to see everybody. Don't forget, we're going to be here in the morning. Slightly delayed start time. Right? Slightly delayed start time for tomorrow morning. We're going to be after the opening range. But definitely looking for trading opportunities tomorrow. So make sure you join me tomorrow. Then Thursday, using the new link for the Options Foundation. Thanks, everybody. Have a great night. As always, happy trading.